All right, welcome back to Urban X TV. Happy New Year to everybody out there. We have DJ the Money Coach back with us to discuss some of the questions a lot of people had regarding the last video and what the new year will bring, what the new year should bring for you with your financial goals and everything. So, welcome back, sir.
Hey, Happy New Year, Malcolm. Welcome back. Happy New Year. Thanks for having me back. That's what I
Right.
meant to say. And Happy New Year to everybody out there in the urban excellence community. Man, get excited, man. I'm excited.
That's it. I am too. I am too. Like, I don't understand why we start the year off with drama, but it's our duty to bring everybody back, so to get everybody back on track with their goals and things like that. So I have some questions that people sent me for you. I have some questions that I had, and that deals with things that people are going into 2019 with heavy on their mind when it comes to finances.
Oh, awesome. Awesome.
So,
Excited, man.
first question actually comes from my mother.
Oh, okay.
Yeah, first question actually comes from my mother. She was just like, "Yo, I had so many questions that I wanted you to ask." I'm like, "All right, text them, I'll ask them the next time we speak." So she's trying to decide which life insurance she should go with. The reps, like, they throwing a lot of these terms out there: whole life insurance, term life insurance, and then she's finding out which one is more expensive. Then she finds out that she can actually borrow against whole life insurance, but it's more expensive. So she's not really sure what she should go with, and she's not really sure what will really like benefit her. So she wanted to know how people should decide on what kind of life insurance and which is more beneficial in the long run.
Okay. You know what? That is an awesome question. So let me start with the basics because first question to that question is, do you even know how to buy life insurance?
Mm-hmm.
And that's really what your mother is asking. Okay. Uh, let me give you an example, and you're gonna better relate to this, and your mom's gonna better relate to this as well. You ever been to the grocery store?
Yes.
Okay. Have you ever bought bread? And have you ever been to the gas station and bought gas?
Yes.
Okay. Tell me the unit of measure that you buy gas in.
Gallons.
By a gallon. That's right. And so when you go to buy gas, you're either looking for the 87 octane, which is the lowest octane, or the premium, which is 93, right?
Right.
And both of those are bought by the gallon, right?
Yes.
So if you can get the premium 93 for the cost of the 87 octane, which one you buying?
Premium.
Buying a premium
Right.
because you're buying it by the gallon, right? So
Right.
you're always looking at the price of per gallon, right?
Yes.
You're not really necessarily looking at the octave 87 and 93. You're looking at the cost per gallon.
Yes.
Isn't that correct? That's how you buy gas. When you go to the grocery store, you buy bread based on what unit of measure?
Me personally, just the brand.
Okay, but when you buy bread, if your mom said, Malcolm, go to the store, get me a blank of bread. What is that word she usually says?
A loaf.
A loaf. You buy bread by the loaf,
Right.
primarily by the ounce. Okay?
Okay.
So those two commodities are bought by a unit of measure. Do you know that life insurance is sold by a unit of measure also?
Yeah. So how are they measured? They
So, so let
measuring.
me give you an example. So your mom said, what's the difference between whole life and term life, right?
Yes.
So if you don't mind me asking, what's the ballpark age of your mom? Is your mom between the age group of 45 to 50 or 45 to 40?
45 to 50.
Okay, so 45 to 50. So in life insurance, you buy, let's say your mom probably wants, let's keep it simple, $100,000 policy, right?
Right.
Okay, so in insurance, there would be a purchase where they say, okay, your mom's 45 to 50, just like me. We're going to sell you a $100,000 policy, and it's going to cost you whole life. It's going to cost you $100 a month. Now that may be on the cheap end, okay?
Right.
And you know, so okay, $100 a month, man, that's a lot. That's $1,200 a year, and that's for 100,000 units. I mean, $100,000 policy. Now you're gonna say, man, I really don't have $100 a month, right?
Right.
But I need that $100,000 coverage. Now, if you knew how to buy insurance and how it's sold, you could actually get that $100,000 because life insurance is sold by the cost per thousand.
Okay, explain that one.
Yeah, okay, so I'm gonna break it down for you. So your mom bought a $100,000 policy,
Right.
okay, and it's sold by the cost per 1,000. So here's how you do the math: take the $1,200 that they told her she was gonna have to spend per year,
Right.
and just divide that into 100,000, and that'll give you the cost per thousand.
Oh.
Now, what's important about that is that how is insurance purchased to get it lower? It's purchased 4 ways: age, weight, your what's called your blood pressure,
Okay.
okay, and are you a smoker or a non-smoker?
Okay.
All right. So I'll use myself as an example. Okay. So I want the $100,000 policy. Your mom was told $100 a month for whole life, right? Now, mind you, let me preface this. This is a hypothetical, okay? Because generally between 45 to 50, if you were to buy a $100,000 policy of whole life, it'd actually probably be about $400 a month, okay? And I'll explain that a little bit later. So I come to the table, and I'm 50, okay? And I say, hey, Mr. Insurance Agent, I have excellent credit. My weight is below the standard of the European model for buying insurance. So I'm what's called preferred. So if the standard person at 50 is weighing, 180, I weigh 165. Check. And I'm in great health. Check. I don't smoke. Check. Now Mr. Insurance Agent, checking out. Oh man. Now, can you give me what a cost is for my $100,000 policy per thousand? He's going to go back and he's going to say, Mr. Deransburg, your cost per thousand is 0.68, 68 cents per thousand. So now let's just do the math. Your mom wanted 100,000 policy, right?
Yep.
So he would go and tell me, all right, so you got 100,000. So you basically want per thousand. So that's 100 units. You got me?
Right.
So 100,000 divided by 100 gives you 100 units. I'm only going to pay 68 cents per 100 units. So 0.68 times 100, Malcolm, is only $68. I now pay $68 per month. In essence, $68 times 12 is $816.
Wow.
Because I knew it was sold by the cost per thousand. I knew it was also predicated on weight, credit, health, and being a non-smoker. Your mother didn't know that. Now, here's the trick. In our community, your mother is healthy. Your mother does meet the weight criterion, doesn't have high blood pressure, and she's a non-smoker. But since she didn't know that, he's going to quote her $100 a month.
So what I'm getting is just, it's like a car salesman, right? Like
exactly.
Okay.
Exactly. So what I do for our members in the 7 spheres of money, I teach them how to buy insurance by the cost per thousand. I also wrote a book, a digital ebook called How to Understand Homeowners, Auto, and Life Insurance Policies. It's about a 30-page ebook that's available that will show you how to break it down. Now, let me come back to the comparison between life, term, and whole life.
Right.
Okay. So there's time and place for both. All right. So if your mom's between 45 and 50, and let's assume she's accumulated some assets. Okay. Your mom got a full-time job?
Right. Yep.
Okay. Has she worked on that job at least 5-10 years?
Yes.
Has she contributed to some type of retirement plan at the job, like a 401k or something like that?
Yes.
So she has some assets that have built up over the period of years.
Right.
Okay, great. So now she's got those assets over there, and let's say your mom is not in the best of health, and that's, I'm not projecting that at all. But let's say your mom's not in the best of health, and she want a policy that she can get, that she can afford, that will always be there. That's when whole life becomes a vehicle, because the word whole means you will pay for it up until you are dead. Okay. Now, for doing that, now when the agent told her, yeah, you can accumulate some cash currency in that policy and you can borrow against it, because when I put $1 into it, Malcolm, the insurance company is going to give me 5 cents value after I've had the policy for about 5 to 10 years. Does it start accumulating cash value? Okay.
Okay.
So now you're paying for that in advance. That's why it becomes more expensive. However, with term insurance, term is just pure protection. Okay? It has no savings attached to it, has no investing attached to it. It's just pure protection. So if your mom is not in position health-wise to qualify for term, because term will be limited. So at 50, you can get a term policy and you can get it up to 75 years of age, but it may not give you all the benefits if you live past 75. But here's the education part, okay? If I buy the right type of term, it can actually be converted into permanent insurance, which is what whole life is. Whole life is just permanent insurance that has savings and investing accounts tabled to it, but you're paying for those extras like a luxury car, and when you don't need it, all that profit is going to them. Let me tell you what a trick what the insurance companies do that erects all these big offices that they have across the world. They actually buy a policy on you. They buy a term policy on your mother while they sell your mother the whole life policy, and they bet on the term so they can actually get the profit in between.
And they're doing this to everybody they cover.
Everybody.
Wow.
Everybody. That's called hedging.
My
so
goodness.
What they do is, I put a policy on Malcolm for, 100,000. Okay. I turn right around and I do an internal policy inside the industry. And most of the companies, about 50% of the companies, own their own internal, company that actually sells these policies. And then they say, well, this is what the true value based on actuary science. And actuary is an accounting term, which means literally by the analytics that for every 100 people that look like Malcolm, have the same, financial profile, the same health profile, the same credit profile, out of every 100, this is the projection of everyone that will die. So out of every 100, maybe 10 of those will die in that frame of your life policy. Now they buy based on that. It's called reinsurance. That's what it's called. It's called reinsurance. So they now say your policy, your mom's policy is $100 a month, but really your mom fits this criterion. Her policy for us is only $50 a month. So they buy a reinsurance policy, boom, give her that policy. So, because God forbid, if she does go to heaven prematurely, they have to pay that $100,000. Right. But based on the actuary science, it says that only 5 people in 60 years pass away. So they've written 100 policies and they only pay out 5. And if your mom happened to be one of those 5, they're collecting 95 $50 a month policies for 100 grand. So your 100 grand that you paid for, they're getting almost $1 million.
Wow, that's crazy. So when they take all those things into account, do they also take into account like where the person's from?
Oh, absolutely. When you mean in terms of the environment, or
yes.
Yeah, they do and they don't.
Okay.
More so pertaining to homeowners insurance and auto insurance, do you get hit if you live in a quote unquote criminal, highly likely to have drama or trauma happen.
Okay.
In life insurance, they really base it on health, blood pressure, credit score, height.
Okay.
Okay. So because they can't discriminate based on your neighborhood. Okay?
Okay.
Now, however, they will discriminate based on what they sell you. You follow me? You see how tricky that can be? So instead of that guy looking and asking your mother the right questions, Mrs., so-and-so, how much do you weigh? Are you a smoker? What's your blood pressure?
Okay.
Now, you're asking me for a whole life, but you know what? You qualify for term. Or better yet, you know what? There's a policy called universal life, which is actually a savings policy attached to a term policy that costs a little bit less expensive than whole life. Then they can say, well, you know what? Outside of universal, you can actually have an index life policy that can actually convert over to whole life. So if you don't know the right questions to ask because you have limited education, they're going to sell you what customarily you've been told about.
I have a question. So I know a lot of wealthy people, they like leverage their life insurance for when they pass on, and they're able to pass on like wealth that way. So what kind of life insurance is like, do wealthy people get?
Exactly. That's a great point. So let me break down to you. All life insurance policies have the right time and place for life insurance. Okay?
Okay.
Because whole life is a great policy. It just depends on when do you need it. Does that make sense?
Right. Okay.
When do you need it? Okay. So let me break this down for you. I'm gonna pull up. Let me pull up a little slide here. I got my book in front of me, and I'm gonna send it to you. Okay. So here. So in my class, can you see this?
Yes.
Okay. So it says investing in your family. Okay. So there's 4 or 5 different policies that one should get as they go through life. Okay.
Okay.
All right. So when you first start out and you don't have anything and you know you're going to live for a long time, the term is the most attractive because it's the least expensive, because it's just pure protection. Okay. It doesn't have any savings vehicles attached to it. It doesn't have any investing vehicles attached to it. Okay.
Okay.
So when you attach those other vehicles to it, they cost more money because those are extras. They have more risk of their assets being attacked. So they're going to go and get a permanent life policy, which is a whole life. They're going to get a variable universal life policy, which is a policy that enables you to invest in the market. So what this policy would do, for $100,000, you will pay, let's say, $300 a month. But out of that $300, only 100 of it covers the $100,000 policy, right?
Okay.
The other 200 is actually invested in the stock market. So if the market's up, the value of your policy immediately goes up with the value of the market. Now, conversely, if the market goes down, Malcolm, your policy value goes down too, because it's a stock. That's why it's called a variable universal life, which the person who sells it to you have to have a security license in conjunction with a life insurance license. Okay. Now, the borrowing aspect. This as an investment tool, you can borrow against it. But here's the thing. When you borrow against it, you have to pay interest on it as well. Now, if you're not in position as a business owner, as a wealthy person, is there any reason why you should have a variable universal life policy?
No.
But guess what? It's sold to people. How do I know? You get 3 guesses. The first 2 don't count now.
Some of your clients have found themselves in a hole because they were sold the wrong life insurance.
Good answer, but that's wrong. It's half correct. You get 1 more guess. We went over this the first time when we first talked and you interviewed me. I told you every time you get 3 guesses, the first 2 don't count, and you caught it like the second time. So you get 1 more guess because the first one didn't count. Why do you think I really know?
That happened, didn't that? You said that happened to your mom.
Happened to my mom, and it happened to me too.
Okay.
Okay, so here's what happened. When I was actually your age, 27, I had started my first cleaning company, and I was making a lot of money. And an insurance agent, I'm not going to say what company he was from, he kept pursuing me because he met me at these business networking events, which is smart. And eventually, after like 9 months, I was like, man, dude, just show me what you got. So he started telling me about this sexy product called Variable Universal Life. You're a business owner. You can take money, get you in some insurance, invest in the market at the same time. Oh man, sign me up, Malcolm.
Right.
Signed up, put my $350 a month commitment, no, $300 a month commitment, and then fortunately for me, there's called a look back, policy in all of them. You get 10 days, some you get 20.
Okay.
I happened to start reading the document and found out, oh, when the market's up, I make a ton of money. When the market crashes, my value goes down and I can owe money. Then when I like the part by having an asset I could borrow against to get some other capital to invest in other businesses,
right.
I had to pay above average interest. I was like, why would I have to pay interest on my own coin?
Right.
So I went back and asked him, hey, dude, what's the deal with that? He said, yeah, man, that's just the way it works. I said, well, I'm not making that much money that I want when the market goes up, I win, but when it goes down, my value goes down. And when I want to borrow, I got to pay 6-7% when the interest right now at the bank is only 3%. So he said, well, hey, man, that's the one that I thought would be a fit for you. I said, okay, I did some research. How about you get me a return on premium? So to bring this story back in, to not make it so elongated, is that vehicle in of itself has a purpose, because at that point in time, like your mom, if I have assets and I'm in good health and I can afford to pay for the whole life policy, and I don't mind paying a small amount of $100 a month because I'm accumulating, long-term value. A whole life policy is not going to accumulate a whole bunch of cash value until you've had it 20, 30 years. Now, let me ask you a question. If you're just middle class and you've been knocking down $1,200 a year payments for 30 years, how much money did you pay into that policy? 1,200 times 30 gives you how much?
Hold on.
$36,000.
Yeah, and that doesn't even.
Yeah. Now, ask yourself a question. How much do you think that cash value in that whole life policy going to be worth in year 30? You think they're going to give you $36,000, or it's going to be worth less?
Less.
It's going to be worth less.
Yeah, less.
That is correct.
So
if it's going to be worth less, but you did pay $36,000 in, if you knew how to buy insurance and bought it properly, would that been the right vehicle for you? Now, conversely, if I'm only paying $1,200 and I put 36 in, and I'm a lot older, my health is a lot, more shakier, and I needed that to pay off just some living expenses or final expenses, $36,000 for a $100,000 exchange is minimal, because as a purchase in a business, that's a tax write-off too. You follow me?
Right.
So I bought it for the right reason. Now, let's go back to those other two vehicles, okay? Let's go back to the variable universal life. When is variable universal life a proper tool? It's a proper tool when I have a business that's growing. I have some assets that have matured, like where your mom is right now. I don't need the savings part, but I want the investment and I want some cash part. And I understand that when I put the money in, that the market goes up, the value goes up. So if I'm cashing out when the value's up, that's a win, okay? When I want to borrow against it, I understand that I'm paying that extra interest for the borrow. So if I'm going to be protecting my other assets that have grown over 10 years of investing, then that might be the right vehicle for me. Does that make sense?
Yes.
If I don't have any other avenues. So you have to ask yourself first, what am I buying the insurance for? Am I buying for pure protection, which is the cheapest I'm going to pay for it, which is term? Am I buying to have it as a savings vehicle? That's universal life. I want to have some savings attached to it. But I also understand for every dollar I put into it, Malcolm, I'm only going to get back 5 cents after a period of years. I'm going to say that again. If I put every dollar I put in, I'm only going to get back 5 cents after a period of years. And that's usually after about 10 years that I'm going to start accumulating 5 cents for every dollar that I put in. But there's a time and a place for that. Does that make sense?
Yeah.
Now I'm saying, you know what? I need a vehicle that has savings and investing attached to it, because I'm at that point in my life. I'm in a startup business. For instance, you're in a startup business. Let's say you got some investors, and they said, Malcolm, if something were to happen to Malcolm, we want to have some collateral to our investment in Malcolm. Now maybe a variable universal life is good because it protects their interests. You follow me? Because you'll have 100 grand, you have some accumulation, and let's say the market doubled in 2019, your policy became worth 200,000, and God forbid you were in some negative situation that you were, no longer with us. Your investor, your beneficiaries each get to split $200,000 because the market doubled and you only bought 100,000 policy, but you bought a variable universal life and it was invested in the market, and that value is what the value is.
Okay.
That makes sense?
Yep.
Or I'm just Malcolm regular and I'm just starting out with my business. I don't have many assets, but I see the wisdom of having term in protection in of itself. I get the pure protection, but I get even smarter and I say, hey, you know what? DJ, the money coach, told me there's a policy for young professionals like myself called a return on premium. What's that? 9 out of 10 insurance agents don't have a clue what return on premium is. Well, guess what? This, Malcolm, is you have the policy for 20 years and you're still with us at 45, and the policy now has matured because the 20 years up. The insurance company now gives you back every dollar that you put into that policy. So you put 100 in, 1,200 a year, you get 24 grand back. Guess what you can do with that 24 grand? You now can put a clause. There's a clause that you can put in all insurance policies that are not permanent protection, which what home life is. It says at year 15, I want to convert this over to permanent life insurance, and whatever percentage of that covers this amount, the 100 grand, I want you to take that portion of the money and keep putting it into that policy, and what's left, give it back to Malcolm.
Wow.
That's how you should be attacking the insurance. That's how your mother should be attacking insurance. And then when everything's equal, you should say the most important statement. Mr. Insurance Agent, what is my cost per thousand? Because in that model we first started out with the whole life, your mother was paying $100, $1,200. So you would take the $1,200 divided by the 100 units, and she was paying well over $3 per thousand. I was only paying 68 cents per thousand. You got me? So I'm gonna break it down real quickly. So people out there in urban excellence community, they say, "What I don't get?" Okay, so here's what you do: you take 100,000. Okay, write this down, Malcolm, because it's real simple. So you take 100,000. Insurance is bought by units of cost per thousand. So if I got a $100,000 policy, I'm gonna divide 100,000 by $1,000. Okay. So I take 100,000 divided by 1,000. That gives me 100 units. 100 units. So I'm buying 100 units of life insurance. Now, let's see what our mom paid. Mom paid $1,200 a year. So now you divide 1,200 by 100. Mom's paying $12 per unit. That's a lot.
Yes.
Mom's being ripped off now.
Right.
You got me?
Yeah.
I'm paying 0.68. But if I don't know what the cost per thousand is, and again, real simple, everybody out there in urban excellence land. So if I got a $500,000 policy, was typically what most people would have at age 50, they'd have about a $500,000 policy. Okay. I take that, I divide that by 1,000. Okay. Because that's what you buy it, cost per thousand. All right. So your mom will really only have 500 units. Okay. So now, if your mom were paying, again, $1,200, I would take the $1,200, I would divide that by the 500 units, and she would only be paying $2.40 per thousand. That's a great average rate. Okay. Now let's see what I would be paying. Your mom will be paying $240, and I'll give you a prime example. This is how transparent I am. I have one $500,000 policy. Okay. I pay $30 a month for $500,000.
Wow.
So that's $360 a year for $500,000. So now what I do is I take the 500 units. Okay. I divide that by 360. And I'm only paying $1.38.
Wow. Yeah. See, a lot of people in our community don't know these things, man. Like, and it's unfortunate because it's unfortunate. going back to the last time we spoke, it's unfortunate because a lot of people are not taught these things, and like we just made the connection between like a life insurance salesman and the car insurance, so they're trying to get what they can get.
Right. Now, let me preface this. I'm not down on life insurance agents, car agents, because there's professionals out there. Here's what we have to disclaimer, okay? Because I'm not about besmirching people's reputation in the marketplace. Here's the deal: insurance companies, car companies, any company, their job is to sell the number one product that they have at the highest profit margin, that they can sell it at. Your job as a consumer is to find out the most information and how to buy the product the way they sell it internally. Because you can have new people in the market that go work for ABC Insurance Company, and they're told this is our quota this year to sell this particular product whole life. And the reason why they tell you, because that's their most profitable. But if all they teach you is how to sell whole life, and you go up to the wrong person and you have no intention of harming them, but you're telling them everything about whole life and they don't know how to buy, they just know they need insurance, and the number fits their affordability quotient. Let me say that again. The number fits their affordability quotient, because the insurance agent will always ask you, how much can you afford? Not what do you need to buy? How much can you afford? It's not his or her job to determine how much you can buy. You know whose job that is? That's your job and your team to say, here's what your true need is. Here's what you can afford to buy, and match them up together. Does that make sense?
It does. It does.
I know in your community, you have people who are insurance agents, and they're great. I have a life insurance license. I have a home and auto, license as well. So I can sell insurance, but I don't want to be given a negative connotation about me as a professional if I'm going out and doing it and teaching people how to buy it.
Understand. Okay.
Does that make sense? So I want to make sure we clarify that.
Yeah, thank you. That was thank you. Because thinking about it like that, it brings more humility to the people. Because a lot of times like I just said, sometimes you don't really trust the people trying to sell you things, and then once you put it that way, it's like, okay, I get it.
Right. So what the people in the urban excellence community, what they want to do, they want to deal with a professional who educates them first.
Right.
A professional who educates them first.
Right.
And first and foremost, you need to do some homework yourself.
Mm-hmm.
Because at the end of the day, here's what we say at the 7 Spheres of Money. Our objective is to make you your best advisor. Our objective is to make you your best advisor. Why do I say that? Because guess what? When the market's up, everybody loves us, right?
Right.
But when the market goes down, who they point the finger at? At you. Yeah. Instead of pointing at themselves, at you. But you got to have some accountability, because I was not always, responsible. You made the final decision. I just shared the information with you. Okay?
Right.
So that's the education part. So that, in a nutshell, kind of answer that question. Yeah. I know that's very important. And like I was sharing with you, I'll send you some information that they could take a little survey. Can you see that, Malcolm?
Yep.
I'm putting one of these together for the urban excellence community, and I'm going to send to you that you can make it available to your people. Okay?
Okay.
This is a quick 10-question survey that answers some important questions. And the reason why I did that is because, like I told you, I've sat down with 10,000 people personally in 17 years. And I've done the actuary science and know what the questions to ask in all social economic groups. I've sat down with people who have made only $50, a week. And I've sat down with people who make $5,000 and $50,000 a week. So I've seen all the numbers. Okay?
Okay.
What's your next question?
So thank you for that question. Thank you for answering that. That was for my mother. I know you're watching. See, I looked out. So second question, being that it's, the start of 2019, a lot of people have on their, goal list that they want to try to hand in investing, but they have no idea, like investing in the stock market rather, and they have no idea where to start. They have no idea what to even look for. And there's a lot of misinformation online about, and we talked about this before we started recording about, hot tip stocks and people want to get rich quick. And I feel like, that's a recipe for disaster. And I just wanted to get your input on that. And okay. What kind of and if you had any resources, any books that can lead people in the right direction.
Okay, yeah. So first thing is, I'm gonna I'm gonna selfishly self-promote here, if you don't mind.
As you should. As you should.
Right here, I think this is the best book that you can get to answer that question, because as you can see the title here. Can you read that? Can you see that, Malcolm?
The ABCs of Wealth. Common sense strategy. You gotta pull it up a little bit. The common sense strategy for achieving the American dream.
Yep. The common sense strategy. So you said people are starting out 2019. They want to get in, investments. They may not know what investments to invest in. They want the hot tip, things like that. So there's 5 rules to investing. Okay. And I'm going to talk about principles. I'm not going to talk about vehicles. I'm not going to talk about tools. Okay. Because you need to have principles before you do anything. Okay. We need to be centered and foundationally firm in principles. And Robert Kiyosaki says you need to have 3 things to become wealthy as an investor. You need to have education. You're going to keep hearing me, man. I'm going to beat that like a dead horse. You got to have education. Okay. You got to have experience. And then you got to have access to resources, or what he really says, have access to capital. Okay. So I'm going to say that again. Got to have education. Got to have experience. Got to have access or resource to capital. So here are 5 basic investment rules that I teach people in the 7 spheres of money in our seminars and courses across the country. Okay. Rule number 1. This is out of my book. It's called Family Finances 101. Is pay yourself first. So what does that mean? If you make $100 this month, knock off 10% of that $100, $10, and put in a savings account. Okay.
Right.
I didn't say an investment account. I said a savings account, because if you don't know how to invest, you don't know how the stock market works, you don't know what a mutual fund is, you don't know what a bond is, it's better to hold on to the money than throw it out into the market for a hot tip.
Right.
Okay. All right.
Is 10% like the standard?
That's the bare minimum.
Bare minimum.
That's the bare minimum. If I'm young like Malcolm and I don't have a lot of expenses outside of, if you had student loans or whatever, even though those can be, very, minimum at times, I'm going to chop off 30% if I can.
Okay.
I'm going to chop off 30%. So actually, and I'll touch base on that, but the minimum should be 10%.
Okay.
Okay. And that's part of your plan. That's not a tip. That's part of your plan. Okay. That's the education process of your plan. So I'm going to chop off and pay myself first $10 out of every 100 that I make. That's the first thing I'm going to do. Okay. Rule number 2, I'm going to build myself an emergency fund. I'm going to build myself an emergency fund between 3 to 6 months of my gross income. Rule number 2, I'm going to build myself an emergency fund between 3 to 6 months of my gross income. So again, if you make $100 a month gross income, I'm going to see what that equals on 3 months and 6 months, because guess what, Malcolm? If I lose my job, I'm going to need to pay my bills for the immediate 30, 60, 90 days. Okay? So if I make $100 a month and I knock off what will be 3 months, I need to store up $300.
Right.
So you're probably saying, well, DJ, the money coach, how does that relate to me investing in the market? Well, guess what? You invested in yourself first. Let me tell all your listeners, and we can end this interview right now. Any of you out there have a credit card, and your credit card interest rate is anywhere from 7 to 20% interest. Let me tell you how to make 7 to 20% interest right away. Pay off that credit card. That's it. You just made 20% this year. Don't worry about anything else. I think the most foolish thing people can do, you're encumbered by a whole bunch of debt and paying interest on that debt, and then you out there trying to invest in other stuff that you're not really an expert at, instead of knocking down that debt and getting yourself from underneath that, ball.
Right.
Okay, so that's number 2. All right. So rule number 3. Now here we're going to come into some actual investing, which is what your people want. I'm going to invest into a mutual fund. Okay. And I'm going to use a mutual fund for periods that I want to save and invest for at least 5 more years, 5+ years. Okay. That's what a mutual fund is for. So you use mutual funds to save for periods between 6 to 5 years or more. Okay. All right. Now, some of your old timers will say, well, hey, DJ, the Money Coach, what about a certificate of deposit? You know what? A certificate of deposit is a good vehicle, but it's an outdated vehicle and it's a dinosaur. And all a certificate of deposit is, Malcolm, it basically just guarantees your $100 you put in for a very minimal return on investment, like 1%. Robert Kiyosaki calls that a certificate of depreciation. But if we have people out there in my age group or older who follow you and follow your dad, we're going to address that, because at some point in time when the market is really unstable and money has been devalued tremendously, if I have $100, I don't want it to be worth $90 next year. I want it to be worth $100. Right. So built up that $100, nest egg, I want to put that in a security certificate of deposit, because I'm guaranteed by the bank and insurance companies and by the government that I would never lose my 100, even if the bank goes bankrupt. You got right. For young people like you, your mom, that's not a vehicle that I'm utilizing. There's other better vehicles, but I want to let them know about that vehicle. Okay. All right. And then you want to take, once you've done that, now when you go on above 5 years or more, you want to come back, apply towards that mutual fund. And what a mutual fund is, just a group of funds professionally managed by professional investor money managers. Okay. And that's typically what all 401ks are invested in. About 80% of them are in mutual funds and about 20% are in individual stocks. Okay. So the next rule is, when I've done those, now I want to take that investment strategy and I want to make sure that I have a Roth IRA. And a Roth IRA is going to consist of mutual funds, independent stocks, and bonds. Some cases, very few bonds, but mostly are mutual funds and individual stocks. Okay. Now, from a reading standpoint, I'm going to give you really a basic book. I don't want to make it too complicated, but I think you cannot go wrong if you were to step in and look at two basic books. Okay. Everybody know who this guy right here is, right? Yep. Warren Buffett, Way of Investing. Okay. And the reason why I promote Warren Buffett is because I don't get paid anything for telling you about this book, but if he is the #1 stock investor on the planet, maybe you might want to listen to some of the things that he got to say. Right. Now, I know we out here and we probably say, hey man, what about the black investors and stuff that you should refer us to? Hey, you know what? At the end of the day, we live in a capitalistic world. And if you can show me Robert Smith, who is the wealthiest billionaire and the wealthiest black person in America, Robert Smith, look him up. He just gave an endowment to, I think it's Cornell University, for scholarships for STEM recipients to actually make money. He's a hedge fund manager. He's the wealthiest black person in America, Robert Smith. Look him up. I don't know of any books that Robert Smith has written yet. Right. But as soon as he writes one, I recommend it to you. Does that make sense? Yes, it does. Okay, so hopefully we check that off. Keep it, as your dad said, I'm gonna keep it a buck. But for right now, I'm gonna tell you about the guy who makes more money in the world of stock investing than anybody on the planet, and he has this little small company called Berkshire Hathaway, who one individual stock costs over $20,000. Ooh. Wow. You feel me? Yeah. Now, I'm also going to teach you about the importance of passive income, because we should invest in vehicles that are passive based, income, where you work hard building up the pipeline, then it pays you for the rest of your life where you don't have to do work on it. So one stock that you want to focus on and your community wants to focus on are dividend stocks. Dividend stocks, okay? And what dividend stocks are, they are payments to stockholders from the earnings of the corporations, not the profits, the earnings. And they generally are doled out by companies for tax write-offs, or they're what called blue chip companies. So like IBM, Shell, Exxon, these are companies that have been around 40, 50, 100 years, and they're not going to grow anymore exponentially. They're going to just have incremental, increases in their market share, 1%, 2%, 4%. They're not going to have 20, 30, 40 like a startup company or a growth company. But since they have so much excess of cash on hand, they want to eliminate their tax burden, which what we just saw happen with Trump. Trump just now brought back and lowered capital gains for corporations, which he's now going to have a lot of that money coming back to America.
Okay.
But he penalized the middle class. So what he gave to the corporate companies to bring that money offshore back here, he's taxing the middle class, and he's eliminating some of the earned income credits. Okay. So I don't want to get too complicated in that, but I'm just trying to patch together, let you understand how dividend stock work, because these companies who have billions and billions of dollars of cash on hand, and they don't want to be taxed on it any more than they're being taxed, they get a loophole by the government. Say, hey, ABC company, if you give some of the earnings to your shareholders in what's called a dividend, we will give that 100% tax write-off. That cash on hand now can be a tax write-off if you share some of that with Malcolm and with the Money Coach DJ, if they were wise enough to buy one of your stocks. And I'll give you a case in point how that works. I have 4 children, and all 4 of my children just made their dividend stock purchase the last week of December. Every last week of December, we actually give them money that they've earned through doing some stuff throughout the year. First and foremost, their grades, character people, representing us well, and other stuff doing charity. Then we give each one of our children, based on their age and their financial IQ, allotment of cash to invest in dividend stocks. And my kids made a purchase from my 14-year-old to my 6-year-old, and bought stocks the last week of December. And those stocks they bought, they were all dividend-based stocks, and they have grown a little bit just in the past couple of weeks. But the dividends, and here's another thing, the dividends are paid out on a quarterly basis. Every 90 days, the dividends are paid out, okay? And then that will accumulate for you passive income that you reinvest. And when it reinvests, Malcolm, and let's say that $1 stock grew to $1.50, the dividend, since it's growing off of it, you reinvest it, so it actually buys a percentage of the stock. So in 10 years, if you never invested anything more in it, you could actually accumulate enough dividends to actually buy more of the stock without putting any more money in.
Wow.
That's powerful.
Yeah. Wow.
That's powerful. So when we start talking about these vehicles, we want to get an education on how the market works, how investing works, and then we want to know what vehicle will accelerate my plan. Does that make sense?
It does.
And we accelerate my plan. Hopefully, does that answer the question, or did you need me to drill down a little bit more for you? Because again, I'm not going to give stock advice. I'm going to teach you about education. I'm going to teach you about access, and I'm going to teach you about asking the right questions to work with the right professional. And then at that point, that professional should help you become your best advisor.
Right.
And that's exactly what we do.
All right. I asked you about like investing apps like Robinhood or Stash. Like, I want to know how you feel about them, because some people don't know if they should trust these apps at all, and then some people like go into using these apps without the actual education that is needed to be an investor. So I wanted to know what you thought about them.
Okay, so I think they're incredible vehicles, first and foremost. Incredible vehicles. Okay, so if you are a high IQ, financial intelligent person, I think you should use those immediately. And here's why I say so. Because when you invest in the market with a typical broker, there are fees. Okay, there are fees, because that's how they make their money. There are fees. I don't know if you've seen those commercials recently of, I don't want to give out any names, but they're so adamant out there. But you have a commercial where they show one brokerage company is now guaranteeing you, if you don't make money, they don't charge you fees. Have you seen that commercial?
Yes.
And then they show the one where the guy's out on the golf course and they keep showing the big ads roll. Well, Bob, they don't have to pay fees anymore. Man, he's running, right? So basically here's the beautiful thing about being a millennial like yourself. You now realize, hey, man, we do live in a capitalistic world. Me, your mom, and most importantly, our parents did not have access to that information.
Right.
They didn't realize, we live in a capitalistic world, but it's really a capitalistic world where everything that you do, there's a fee, a service, a charge rendered to it. But you don't have to necessarily pay that, because then we didn't have the vehicles to give us access to that information. The internet has exposed it, and now the apps say, hey, you know what? You can go online, get your own stock, get your own ETF, which is a electronic transferred fund that has a combination of mutual funds and derivatives and stuff in it, and you can buy it without having to pay DJ the money coach, who's licensed in securities, a fee to make that transaction for you. Mm. So if you are educated, have experience, and have access to the resources, Stash, Robinhood, ABC app is the best thing, because guess what? They're going to charge you little to no fees, because they're giving you access and they're selling your profile to advertisers to pay